The European Central Bank tells the narrative that the war on inflation is won, simply because the total number has decreased below 2% after many years. That is a statistical illusion, because looking at the headline number alone lets you forget of all the methods companies use to reduce volume per size, reduce the quality of ingredients, and the overall stagnation that is affecting Europe over the past months. Today, we are looking at all the ways your purchase power is decreased via all the forms of inflation and the mathematical probability of each of those types of inflation to further erode your quality of life for the rest of 2026. Let's look at the data. Hello fellow wealth seekers! Let's look at the basic deep dive. Headline inflation versus core inflation. The first being simply the total cost of what you buy versus last year. The second, removing food and energy price cost. Why? Because these are considered too volatile, structurally ever-changing. By doing so, you remove an actual part of the economy that everybody pays for every single day. Think of the oil crisis in the 70s, where headline inflation was running up and the core inflation was lagging behind, but eventually caught up simply because the overall cost lifted through the years. Now, in February 26, this is an absolute reality. Headline inflation is at 1.9% in the Eurozone, while core inflation climbed versus January 26 to 2.4%. So we are already looking at higher prices due to service costs such as insurance or software that excludes food and energy, which are, by the way, likely to increase even further with the recent crisis. Which brings us to food and energy costs alone. This is extremely important. It's not simply the bank printing money to give a boost to the economy. Here we're looking at a reaction to external supply shock. Think of Russia's invasion in Ukraine 4 years ago that sent gas prices spiking up due to the tariffs against Russia being one of the number one provider of gas for the rest of Europe. Or the supply crisis during COVID, where people were not able to catch up with basic essentials at the grocery store and production couldn't keep up. Here we're looking at extreme criticality in March 2026 because gas prices driven by the invasion in Iran and the subsequent pushback from the country, we are looking at 50 to 80% spikes in Europe after the closure of the Hormuz passage. Then let's look at two effects that do not show up in the ECB's inflation rate report, but that mathematically degrade middle and lower class style even more than the basic inflation. This is shrinkflation. Same price, but 10 to 15% lower volumes, lower quantities for what you pay, and skimpflation, lower quality of purchases or services, despite paying exactly the same. Think of Toblerone, which famously increased distance between their chocolates in 2016, or airlines not offering economy meals anymore since a decade now. Or a hotel not offering daily cleaning anymore. Well, this is also great for the environment, but you're still paying the same rate as if all the services are still included. Do you think that's fair? Which leads us to the nightmare scenario we might be facing now, stagflation. This is where the economy is stagnating, unemployment creeps up, but prices increase anyway due to the overall supply and demand global situation. Think of the 70s again, US and the UK facing double-digit interest rates while being crushed by food and energy rising costs due to the oil shock. Now, if the conflict in the Middle East continues and the energy shock escalates, the ECB will be forced to either decrease their interest rates and see inflation explode mathematically, or increase them further and effectively collapse the economy, making it a very brutal slowdown. And why do I say this is highly realistic now? Think of Germany, with their economy 9% down in terms of output since 2021. We're basically looking at the historical giant of Europe producing 9% less over 4 years, where technically it should have increased by the same amount. So we are almost 20% off versus where we should be with our primary economy. Finally, for completion, we must understand the polar opposite, deflation, a sustained decrease in goods and service prices. This may seem good, but actually for highly indebted countries, like a majority of the world right now, it is a nightmare. Why? Think of the Great Depression in the 30s, or Japan's lost decades, basically the last 30 years. If prices keep decreasing and the consumer realizes that, they stop spending. They stop spending now in order to get a better price later. Companies drastically declining revenues, leading to layoffs, effectively halting the economy. Again, the vicious circle continues. We are unlikely to face this right now in Europe simply because of the overall pulse of the economy, but there is one specific sector, imported goods, where this is the case already. Think of China, that in order to face their own internal crisis is dumping cheap EVs and cheap solar panels into the European economy to keep gaining money out of that, basically outpricing and outcutting all the local suppliers and manufacturers, such as Germany. In conclusion, be aware of everything that's happening around you, whether it's the local shrinkflation or a broader exposure of your portfolio to supply shocks and stagnant economies across the world. Assess your exposure, your portfolio, your positioning. I will make a video over the next days on how to better optimize your wealth allocation according to the potential stagflation we might be facing. I hope this was helpful. Until the next session, European Wealth Lab out.